Good morning, everybody. Happy Monday. Not a terrific open, 3-1, declining to advancing stocks. Europe is closed for the holiday, so not a lot of help to us right now. Just take a look at sectors. We started off positive with energy on the deal announcement, but even energy's turned weaker here. Banks are notably weak. J.P. Morgan, remember, reporting very shortly tomorrow, down about 2% here. So consumer staples weak, industrials also a little bit on the weak side. There's your energy stocks. They were all positive right at the open. These are high beta energy names that would benefit from any kind of deal at all. They move more than the market. As you can see, even they are on the flattish side right now here. Goldman talked about that deal, saying it's historic but insufficient. Interesting comment from them. So where are we in the markets right now? We're sort of gone through several different phases of the coronavirus. We went through that February 20th to March 23rd phase. I call it the panic phase, where we dropped 34% on the S&P 500. Then we went to the rally phase. I guess you call it relief or fear of missing out phase, where we rallied 24% off the lows. Now where are we? Are we? Some people, Tony Dwyer was calling it a frustration phase that we're likely to enter right now, where we still have really negative news on the shutdown, on earnings that are coming overall. And of course, we still every day come up and I put together lists of companies that are withdrawing guidance or furloughing people. I think this is a useful way to realize that this is still very much an ongoing crisis. So Grubhub today withdrew their guidance. A whole bunch of companies in the last day or so announced they're furloughing people, including Tupperware and Groupon and Live Nation, and even Disney World employees getting furloughed as well. So always useful to realize that there's real damage here, and it's very hard to pick a bottom right now here. So what are we expecting from earnings season? It's been very, very difficult to figure out. I've never seen a dispersion between analyst estimates like I've had for Q2 and numbers. They're just all over the place. They are essentially useless. I hate to say that, but I don't find much solace in looking at the earnings guidance. We have more than 70, probably close to 100 by now, companies that are withdrawing their guidance for the quarter or for the full year. How are you going to estimate anything about global guidance in the S&P when so many companies are withdrawing the guidance? But people are trying it. I am somewhat heartened. Noted this last week that a number of the big top-down strategists that we have on all the time are coalescing their estimates for the decline in 2020, somewhere around 20 to 30%. Now, you might say, well, that you could drive a truck through these estimates, 33% to 19%. That's a big dispersion, but actually that's a lot better than it was about 2 or 3 weeks ago when nobody had any idea what the numbers are. So at least they're starting to coalesce around some idea about where things might be going. We're going to be getting banks this week and, of course, J.P. Morgan tomorrow, but I tend to look at the regional banks and what they might have to say, because they're the engines of a lot of the local growth, and they're going to be hit by the brunt of the lower provisions for credit loss or higher provisions for credit losses, which I think is the most important thing. I want to hear about how many loan losses they've got out there. They're going to have lower rates and a flatter yield curve, and of course we'll have lower demand. And yes, the government programs will help a little bit, but remember, these regional banks make loans out to companies, to the restaurants that are out there, to all of these small businesses that are out there. And I want to know what kind of loan loss provisions they're going to have. And remember, they're also big asset managers, too, on top of that. So if you get lower trading activity, lower value of the stocks, lower value overall, they get paid less on that because they get paid a percentage of the assets under management. So even asset management, a growth area for all of these banks, a bit of a problem. There you see some of the regional banks all down as we go into this. And I just want to point out what's been going on here, because regional, there is an ETF for this. KRE is the regional bank, just regional banks, not the big global United States-centric banks like Citigroup. Here you see, look at this number here, 55. It was the end of February. It went to 27 on March 23rd. And yeah, it's rallied. Now we're at 36 or 37. But 55 to 27 to 37 or so, that's a pretty modest rally off of the lows. Yes, it's a rally. So just remember here, we're down 30%, those banks, from 6 weeks ago. And the market is very much pricing in some negative commentary in the next few weeks. So we'll see exactly what goes on with that. The key here is just getting any kind of commentary or guidance at all. The SEC has made it clear, go ahead, tell us everything you know. We will not come after you if you change that guidance a couple of weeks from now. We're giving you essentially safe harbor to be straightforward with us and don't hold back. I think that's going to be good news. At least we'll hear from these companies about what they really think is going on.